Hi, everyone. This is Michael Duncan with CamaPlan, and thanks for hanging by there. We're going to get started here in a second. First, I would just like to give a quick introduction. Today, we're going to be given a presentation by Mr. Peter Powers. Thanks for joining us, Peter. And the presentation is going to be the Family Office Blueprint, now available to CamaPlan investors. And I'm just going to read a quick disclosure. CamaPlan does not provide investment advice or endorsements due to the nature of our industry. CamaPlan is not an investment provider, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. All information and materials presented on CamaPlan webinars and podcasts are provided for educational purposes only. We strongly encourage you to consult with your attorneys, accountants, and financial advisors before entering any type of investment. But if you have any questions for us, you can give us a call at 215-283-2868 or shoot us an email at engage@camaplan.com. And with that, Peter, I'm going to turn it over to you and let you take the wheel.
Yeah. Well, Michael, I appreciate you for having me on your guys's webinar, podcast, whatever you guys call it. And again, I've grown to build a strong relationship with CamaPlan over these last 7 years. I started using CamaPlan in 2018 by the recommendation or through the recommendation of my CPA, who's based out of Pennsylvania. He mentioned your guys's Roth IRA service, the low cost nature of it, and what really caught me is the accessibility. I've been using it for 7 years in various different investments. It's very straightforward, as a lot of your guys' clients probably know. Get on the computer, it's pretty secure, but you're able to make investments in all different types of alternative assets. And my focus is real estate, so it's definitely come in handy. So like to give a little bit of background on myself and then my company. So my name is Peter Powers. I'm the co-founder and managing partner at SP Venture Partners, which serves as like a real estate arm for various different families across the country and a few internationally. We started this business in early 2023 after myself and my business partners experience in the family office space. So let's start off with what a family office is. Family office is essentially an investment unit for a particular family. So people have probably heard family offices of like Jeff Bezos or Elon Musk or Bill Gates. But there's thousands of family offices in the US and even more around the world. And their goal is to take the money that these families have made or are making and to diversify it into other assets that are not correlated to the business that family typically originated their money in. So for Bill Gates, for example, he has real estate. He's the biggest owner of farmland. He has technology investments. He has philanthropy. That's the nature and that's the purpose of a family office. Something what we've seen, myself and my business partner Sean, is he came from a family office in local one out of Tampa Bay. I was with my family's investment office out of Tampa Bay in Pittsburgh. Is that there are families all across the country and the world that have significant wealth that just don't have either have the resources, the know-how, or just don't want to go through the administrative headaches of building their own family office. So we saw, getting to know other families and entrepreneurs with fast-growing businesses, is that there was an opportunity to serve as the real estate arm where we focus strictly on housing investments, everything from apartments to senior housing. Then we also have a private lending arm. So we focus strictly on real estate. We have the team, we have the underwriting services, the services to do the asset management, the services to do the reporting that a lot of these families look for. So we serve as like the CIO, the asset management, the deal origination for strictly real estate. So instead of these families going out there spending millions of dollars trying to build a team or going through the administrative burden of going through a handful of different CIOs to find the right fit, we serve as that partner what they've grown to like about us is we invest extensively alongside them. So we have meaningful skin in the game. We have direct control of the investments. So as they get to know us, get to know our experience, we're able to actually take that experience. And when we make investments, we're able to carry it out. So we saw a huge opportunity there. That's why we started SD Venture Partners. Since our inception, we've acquired, I think we're right around 250 or $300 million of assets where we, own the majority of and then also control. And those are primarily apartment buildings, senior living facilities. And then we have a loan book where we originate loans from $2 to $7 million, which serves as a platform and as a vehicle for families, for entrepreneurs with fast growing businesses to kind of get current returns. And those returns are anywhere from 12 to 14%. So the evolution of SP Venture Partners is something I want to note is when we started this business, we saw an opportunity to serve as an allocator for families. And then we've kind of pivoted from just being an allocator to also being an operator. So we're the ones that are actually making the management decisions. We're the ones that are actually putting the loans together. We're the ones that are putting the business strategies together. When we started, we were just looking at, let's do a bunch of co-GP joint ventures with, you know, well-rooted firms across the country. And then after, we've really been, growing that experience and have learned a lot, we've decided to take on that operator role ourselves. And it's allowed us to provide a heightened level of transparency because we're controlling everything. So that's very important to families because they have extensive reporting requirements, but also it's helpful for us because if we spot an issue or if we see an issue down the road, we're able to kind of get in front of it a lot sooner than us having a discussion with the JV partner. So we've really changed our model over the last couple of years, just given what we've been hearing from families, what they're looking for, and we just had to find a better way to provide that. So we've kind of evolved over these last couple of years. Something else I kind of wanted to go over is what is our focus, what is our expertise. So I started my career a little over 10 years ago in the property management field for apartments. So I worked with property management companies all across the country. I spent time out in Phoenix doing a lease up. I spent time in downtown St. Petersburg working on value add communities. I spent time up in the Carolinas working on taking an acquisition property that just got acquired and carrying out the business plan, a value add business plan on apartment communities across the Carolinas. So I really got to understand kind of what actually gets these businesses to make money, what things work, what things don't work, and then just kind of how that process plays out. So for example, I'm sure a lot of your viewers, a lot of your clients get pitched investments all the time. And we get pitched investments all the time. There's some investments that we get pitched that look great on the surface level that are a little bit more complicated to play out the way that some of these operators see them playing out. So for example, it's very hard, especially right now, to buy an apartment community or even a senior living facility and carry out a really extensive value add strategy where you're doing renovations and you're trying to push up the rental rates in order to drive net operating income growth. It takes a lot of time. Usually, you used to be able to do it over a couple of years just because rents were going crazy everywhere. So, there was a sense of the ability with the lower interest rates to go in, make extensive renovations, really bump up the rents. And there was just a steady amount of people moving into these towns and cities, across the southeast, which is where we're focused on. What we've been seeing these last couple of years, it's gotten very, very hard just because there is a lot more supply. So when you're going in there and making some of these renovations, you're getting a lot of people that move out of these units. They're not digesting these rent bumps because there's communities down the road that are offering 1, 2, 3 months free rent. So a strategy that some may underwrite to take a year, 2 years is really taking 3 to 5 years because of that extensive turnover. So every time someone moves out, you got to get someone to fill that bed, right? And get someone to move in. But in order to make progress, you got to have an extra person that comes in to increase your occupancy. So that's gotten very tough over the last, I'd say, last couple of years, especially as interest rates have gone up and the new supply has come online. So that's something that we have a lot of experience with because we started in management. We understand that it's easy to say my rents are a couple $100 cheaper than a nearby comparable property, but if you're not taking into account the turnover of those units, sometimes you're going to get yourself in a lot of trouble, which I think is what a lot of operators are facing right now. They had these crazy business plans. They did it with short-term, bridge financing. And I think if they were able to hold on for a few more years, they would be able to carry out their business plan. They would probably be able to make a nice profit. But since that debt and it's coming due and the interest rates are so high, they're unable to service that debt because their occupancy isn't staying where they need it to be. They're not able to see the light at the end of the tunnel. So our experience in operations of apartment buildings and even senior housing, I grew up in a family that had a business that revolved around seniors. So I have a decent experience of what some of those seniors are looking for, the housing they're looking for, what drives their families' decisions to put them into these communities. And that's what really has allowed us to bring a certain level of expertise to the housing asset class and has allowed us to outperform. So right now, I mean, across our multifamily, I mean, we're paying out distributions regularly. We're about to refinance a couple of communities right now, provide extensive distributions to investors because we've been able to buy assets right, been able to conservatively underwrite a business plan, carry out that business plan above and beyond. And I'll go through some more of that as we dive a little bit more into this webinar. But we've also been able to do on the senior housing side, where we're averaging, I think, distributions north of 15%. We've been able to do that because we underwrite conservatively, we buy right, and then we're super conservative on the debt side. And some of these things that we've done in order to drive growth, we can, I guess, start on the income side is, we've been big proponents of implementing technology into our communities. And for the sake of time, I'll focus on apartments and we'll give some examples of some of the technologies that we've been able to put in place. So, for example, on the income side, when we look to buy a community or a community that we own, we're always looking at how can we increase leasing traffic? Because depending on the community, depending on the area, you're going to have turnover between 30 and 50%. So that means, between, half and three quarters of the property are going to renew, and then the other, one third to 50% of the property are going to decide to move out. So you need to have constant people coming in. So we like to look at what technology does our community or community we're looking to buy have. So something that we've been looking and have been implementing is adding AI agents to our communities. So we use all the big marketing channels, everything from apartments.com to apartment list to handing out flyers to nearby businesses. And most of our communities are at size where we have full-time staff. But something that we've done just to make sure that we don't let any hot leads kind of slip through the cracks is that we've implemented AI agents. Now, I ask a lot of people listening today to look at some of these companies from Elise AI to some of the companies like Apartment List has come out with, and kind of review some of the technology they've come out with because it's astounding. You would have no idea, some of these agents, the people you think you're texting or when you call the property management company or the apartment community, the person you're talking to it's artificial intelligence. It's a virtual person. Their know-how, their response, everything is just like a human being, but it's almost exact. So you text them, you ask questions. Hey, I'm looking to move here and here. They're able to give, between here and now, they're able to give you certain different options to rent. If it's a 1 bedroom, a 2 bedroom, a 3 bedroom, they're able to kind of give you an idea if you will qualify for the apartment or some of the things you might need to bring in when you put an application in. And they're also able to assist, for current residents when it comes to work orders. It's a way more efficient system. So we've started to implement AI agents when it comes to the leasing. We've started to implement the AI agents when it comes to the maintenance, to filter maintenance requests and to alert, some of our, human maintenance techs if there's a severe incident. So let's say it's 10 p.m. and a water pipe breaks, or something goes out, and residents lose complete electricity. That technician or whoever that is on call is able to get an immediate alert and take care of that issue as soon as possible. And another technology we've been using, it's been super, super helpful. It's kind of been in the news, and we don't use it like probably most people do, is the revenue management software. So some of these big companies, the apartments.com, the Yardies, they have these algorithms now that I'm sure a lot of your viewers have seen this, if they've looked to rent an apartment. The rates vary by day, and they go up and down, up and down. And really what that algorithm is doing is it's looking at your apartment community, how many of that type of unit you have available, how, what your overall occupancy is for that community, what the rents are in that community, when leases are set to expire, right? You don't want all of your leases expiring at one time, so it kind of likes to spread them out. And it's also looking at nearby communities and kind of vetting where their rates are. So that technology has been very helpful. On the leasing side, it gives us a nice signal of, kind of what's going on in the market. We know that if we see that technology giving us recommendations to, increase rents by 10%, it's kind of an alert to us showing that, one, we have really strong occupancy for that unit type, and then the market in general has strong occupancy for, let's say, a two-bedroom. But where it's really been helpful for us has been on the renewal side, where it's helped manage the lease expirations. So it gives residents optionality in terms of renewals. It gives them optionality in terms of rates. So if it's a 6-month lease, sometimes it's more expensive, sometimes it's cheaper than a 12-month lease. Typically, you go back 3, 5 years ago, if it was a lease under 12 months, it's going to be more expensive. But since it's looking at when leases expire, if it expires in the winter versus expiring in the summer, it's going to give different, lease rates for those months. And we don't use that, religiously, but it's a very strong tool for our on-site staff. So that's some of the technology that we're using on the income side. Something else that's important that kind of goes in lockstep, but this is on the expense side with the technology, is the staffing. So a key item that we look for when we buy a community is how is the community staffed? If you have a maintenance tech, what jobs is that maintenance tech doing? Is he able to actually turn units? Does he have experience in plumbing? Does he have experience in electrical? Now, there's some extensive plumbing and electrical jobs that you have to get an electrician or a plumber for, but there are some, if you need to get a toilet changed out, or if the breaker flips, or a if a washer and dryer needs to be hooked up properly, it'd be nice to get that done in house because it's a lot cheaper. So those are some of the things that we look for when it comes to staffing. That we also, have technology that kind of helps us. And I alluded to that a little bit with the software that kind of takes in the work orders, gives technicians and the property manager an idea of kind of what's going on at the property, to kind of get out ahead of things. If we're seeing a bunch of HVAC, AC units going out in a certain building, there might be a greater issue than just those 1 or 2 units. There could be an overall issue that needs to be looked at. So those are some of the signals and some of the things that we look for when we're looking at a community. Is kind of how's it staffed, what jobs are the current employees doing, what are their capabilities, and then kind of how can we either teach them, or how can we find someone that might be a better better position for that property. Another item that we've been doing, we're on to our third state, is we've been having conversations with counties, with nonprofits, with states when it comes to getting property tax abatements. So our core business when it comes to apartments is providing workforce housing. So we own a couple thousand units. I would say our on the low end, our rents are in the 700s. On our high end, we have rents that are well over $2,000. So we have a wide range, depends on the locale. But each of those apartment communities, wherever they're situated in cities and states, they serve as like the middle market apartment community. And what some of these states have been coming out with, you've seen in Texas, see in North Carolina, South Carolina, Florida, is they have these different tax abatements, right? So we got to go back into what do property taxes do? So property taxes, they go towards the roads, they go towards funding schools, they go towards a fund that a lot of cities and counties have to pay for affordable housing or to give out vouchers. So what some of these states and counties and cities have been doing, because there's an affordability crisis in this country, is they've been giving rewards to property management companies, owners that own properties that provide rents or provide housing at rents that are considered affordable. And for doing that, they'll give you property tax abatements. So we've already done this in North Carolina. We've already done this in South Carolina. We're in the process of doing this in Florida because a lot of these laws have come up. So what's great about that is we agree to the city, the state, the county to artificially keep our rents, to a certain limit. We put an artificial ceiling in place, but for that, they're willing to abate or take away a lot of the property taxes that we would typically have to pay. In some cases, we're going through that process right now on a property we own outside of Orlando. It's going to save us around $300,000 a year. But we're doing something for that. We're giving affordable housing to the community. We're gonna maintain that affordable housing. But it's great for us because we can then use that money, clean up the property, repaint it, keep the property in tip-top shape. So it's a great experience and it's a great home for current and future residents. So that's another strategy that we've been putting into place. It's not only better the lives of future and current residents, but also to make the community something that we're proud of and to make it a more profitable community for our investors. Because as many of you guys know, when it comes to businesses, particularly real estate, are valued off of multiples. So if we're able to save $300,000 in property taxes, and let's say we put at least half of that into the community, right, in some sort of expense, $150,000 comes to the bottom line. That makes that community a lot more valuable, which delivers a higher return for investors, which is what investors are looking for. So to kind of dovetail this into, we spoke a lot about the real estate side, some of the strategies that we do, but why do family offices want to work with us? Myself, my business partner, we're younger guys. We're about 30 years old, but we've been doing this for a good period of time. I'm going on my 10th year right now. Why would they want to work with us? There's groups all across the country. They have access to some of the bigger private equity firms. They have access to, some of the bigger real estate operators, but why work with us? So a big part of it is building that relationship, getting to know them, and then them understanding that experience isn't just how many years you've gone and done something. It's how many big decisions that you've had to make, how many tough decisions that you've had to live with, and kind of what have you learned from that. And what we've been able to show is, we've been a part of investments all over from our prior firms that we were part of to our investments we have now. We've been able to go through some of the tough times that we've experienced, how we got around a lot of those, and some of the learning things we learned while going through that process. And I think it's very important when you're speaking with the family office, because a lot of times we're with the patriarch, the matriarch, they've built businesses. So yeah, we've had times where it's things haven't gone exactly as planned, and we've learned, but we've been able to rebound and do better than what we initially expected on all of our investments. But when you're talking to someone that's built a business, they understand those tough times. They understand that not everything's rosy and you're going to get beat up every day and there's a fire. We always say there's a fire every Monday or Sunday and you got to get it put out by the middle towards end of the week, and then you start again the next week. They like the blocking and the tackling. Us being able to express that, us putting significant capital. I think that's another big part of it is we put significant monies into every investment that we put together. So we just did a loan up in Massachusetts for a big developer, and we were a double-digit percentage of that loan. Now, most investment operators, they're typically only a few percent. Sometimes they'll say they're 10 or 20%, but they're going out there and they're co-GP in it, bringing other investors in, and a lot of times they have no skin in the game because they're making fees off of it and they never actually put anything into the deals. We're doing this business because we're trying to build our own family offices. We're trying to we're big believers in what we do. So if we're big believers in what we do, we're going to put some significant skin in the game, and that comes in the form of us investing actual dollars. It also comes in the form of us signing on, loans on our assets. Where if we don't perform a certain way, there's an ability for some of these lenders to come after us personally, not investors, but us personally. So we have a real stick to us. Like you got to get these strategies carried out, and you got to figure out when you got to figure out solutions when tough things occur. So a lot of the families we work with or that we speak with, they look for that drive, they look for that energy, they look for someone that's going to figure it out. Another part that they look for is how are these investments structured? So you could have the best investment in the world. If it's not structured the right way for investors, investors aren't going to be able to reap the benefits. But the first part you got to look at is how much leverage are they taking on? Leverage is debt, right? How much debt are they taking? So something that we've learned over the last couple of years on investments that we've been a part of or that we've advised other families on is, debt can really, kill investments. It can really take a great deal and turn it into a horrible deal because you're not able to hold on to the investment for as long as you anticipated and you can't see the light at the end of the tunnel. So something that we demonstrate to the families that we work with, the entrepreneurs with fast growing businesses that we onboard to our platform is we show them, the current ability to service that debt service, the future ability to service that debt service, and why we believe the leverage returns are risk adjusted are better than a lot of the other investments that they get. So I think that's another key part that a lot of people were not putting as much weren't giving as enough attention to over the last couple of years that have got a lot of people in situations where they've lost significant money. Um, so that's another important part that we emphasize is how is the deal structured on a leverage side, but also how is it structured on the upside? Are there preferred returns paid? Do investors make money before we make money? Which on all of our deals, before we make a promote or a carried interest, investors need to make a significant amount of money. In some of our investments, investors have to get all of their money back before we make any promote or make any additional monies. So we structure each of our investments slightly differently, but we structure them with the in a way that investors are able to reap upside and they don't have to face the downside that we would in case an investment doesn't go as planned. And the last trait that I want to point out is control of the investment. So when you sit down with someone, sit down with an investor, a family office, a CIO, you walk through a business, you give them your word, you give them a strategy. They want to make sure that you're able to carry it out. And you can have all the confidence in the world, but if you don't actually have the control of that investment, you're not going to be able to step in when times are tough. So we have a level of confidence when we say we're going to do this, 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 and this. If we can't pull that off, these are some of the other, option B, C, and D that we're able to put into place. And we're actually the ones that are going to be able to put in place. We don't have to get a co-manager to agree to it. We're able to actually step in when you need to step in. And a lot of times we don't have to, right? But when something bad happens, you got to have that ability. So even if it's the 5% of the time where something doesn't get carried out the way that it should get carried out. A lot of times it's more than 5%, it's probably 20% or 50% of the time. You got to be able to take that experience. You got to be able to put the right solution into place. And that's when we come to those agreements, we give those investors, those family offices our word. They expect us to be able to carry that out. So I think that's another important part that a lot of operators or allocators, typically allocators, don't mention is they have this rosy picture and look, we wish them the best, but when times are tough, are they able actually to step in? What controls do they have? Who actually makes the decisions? Because those are the people that you want to be talking to. Um, so taking what our experiences in real estate, what some of the family offices are looking for, I think it's best to kind of explain, why am I talking here? What is the opportunity for the CamaPlan users, the CamaPlan clients? So something that we've decided to open up close to 6 months ago, is we wanted to start building a platform where we could take a lot of the strategies, the reporting, the investment opportunities that we provide these families. We want to provide it to entrepreneurs or fast growing businesses, small business owners, people that have businesses, or they're a significant part of someone else's business, that we can provide a real estate arm for them, or at least a real estate strategy for them. So what we've done is we've opened it up to investors that aren't family offices, that write checks in the six figures. Typically our family office investors are writing mid seven figure checks. So we're opening up another avenue for our business where we can work with investors that write smaller checks. And we've built a platform where we still give them the same reporting that these family offices get. We still provide access to most of the deals that these family offices that we invest with get, but they don't have to write the significant checks that some of these families do. So we're launching that right now. We've built a whole investor portal around it, and I think it's something that could be very attractive to CamaPlan users, because of the tax benefit nature of their CamaPlan accounts. If they get into some of our investments, and from our loans to some of our housing investments, they'll have a real tax shield on the distributions that those investments put out. So I think it could be really advantageous for users of CamaPlan, and future clients, to really see the opportunity that a tax advantage account through a CamaPlan can offer them. So that's something that we've been launching. Again, I'm a big believer of CamaPlan. Been using it for since 2018, so 7 years now. It's been a great avenue for me to build wealth. It's also probably the first thing I discuss when I'm speaking with my CPA is, how can we get more money into this CamaPlan account so you can continue making investments and take advantage of the tax advantage nature of like a Roth IRA account. So, I'd love to have discussions with, CamaPlan users that, want to figure out how we can kind of make that happen. But I'll open it up for questions, or, if someone wants me to dive a little bit more into our business in one way or the other, I'll, answer whatever questions you guys may have.
And yeah, if anyone has any questions, feel free to put them in the Q&A section of this Zoom call, and we will see them and we'll be able to answer them live. Peter, I'm just curious, what's a question that you get asked all the time? Because I feel like a lot of times when you're doing these presentations, you probably get very similar questions, and I'm curious if there's one that pops to mind.
Yeah. When we sit down with some of the bigger families, or we sit down with, I'd say, investors that have been through multiple cycles, they'll ask us, they'll ask us about some of our worst deals, or they'll ask us about some of the hairier situations that we've had to deal with. And what I typically bring up is, we've been in a significant number of deals, you know, myself as well as my business partner over these, since we've been in the financial business or the real estate business. And um we've what we've seen is the worst deals that we've come across, it really comes down to structure. So a lot of people, are hearing about how, there's the people in real estate, people in, finance have had a troubling last couple of years. And what we've seen on the investments that did not perform well, it came down to control, it came down to structure. There was a lot of great opportunities out there. There's great opportunities people got into, but they were structured in a way where the investors couldn't see light at the end of the tunnel, because they kind of had a gun to their head, for lack of a better phrase. They had a 2 year hold period. They paired it with 2 year debt. The short term debt put them in a situation where they had to execute a business plan with very little hiccups. And if they didn't, then there would be the investment could turn very, very sour. So we typically, discuss some of the some of the worst structures that we've seen, how it's really limited investors, how it's really diluted investors, and made it very hard for them to get their money back, or for them to make a decision to make the investment maybe perform better. So it typically comes down to structure and control, and if you don't have the right structure, a lot of times you don't have the right control, and can turn any potential investment into a sour investment.
Well, we did get a couple of questions here. First from DG. What is your minimum investment contribution you can accept, and do we have to be an accredited investor?
You have to be an accredited investor. So all our investors are accredited. Our smallest investment amounts $100,000.
Nice and simple. Next, from Herv, will you be offering different share classes and returns to your new individual investors versus the share classes and returns you offer to your family office investors?
So it depends on the investment, but typically there would be a slightly different structure for an investor that comes in. Let's say it's a investment where we're bringing in $5 million of equity. We have some investors that might put up $2 million. Those investors are going to get a different structure, probably more beneficial structure than an investor that is only investing $100,000. And the main reason for that is it's not just the amount of money that they're investing, but once an investor is over a certain percentage of a deal, there's certain controls that a lender will kind of, and a lender sees that they have, because they're a significant weight of the monies, right? So if I did do a capital call or ask for additional monies, since they're X percent or over X percent, they can withhold, decide to not invest, or decide to invest more money. That could change the nature of the investment. So we typically have to give them, better, maybe a slightly higher preferred return or slightly better waterfall structure, but it's not significantly different than what we would offer a CamaPlan investor.
Awesome. Uh, and as a follow-up, Sandra, we will get to you in a sec. Do your family office investors ask for control or voting rights in your investments?
Every investment that we've done, this will, I can never say it's going to go on forever. We've never given up control of our investments. We're always, myself, my business partner, are the ones that are making the decisions. They do come in as limited partners. We have in the past done, sometimes they'll bring investments to us. We'll do a joint venture with them. But it's really just, my business partner and myself. We're not bringing other investments into those types of deals. So those ones where they brought us a deal, they'll control it, but we're not bringing other investors into those. So those are separate, comparison to the deals that, we bring forth through the SP Venture Partners name.
Makes sense. And the last one we have at this moment, anyway, is from Sandra. What is the entity holding title to the real estate? Do these investments qualify for 1031 exchange? And what is the average length of an investment?
So we have two different types of investments. We have our housing investments. So those are all individual entities. Some of them do qualify for 1031. We have some that don't qualify for 1031. I would say most of the time we're able to qualify for it. When I say qualify, most of the time if we put an investment together, we could structure it where we could have someone put 1031 monies in. But also, when we go and sell the property, or sell the housing asset, we have the option to 1031 into something else. And then we have our private lending. Our private lending doesn't have a 1031 option because we're not actually owners of the real estate. We're going to be the lenders, the senior loan on the real estate. So the 1031 wouldn't really work in that scenario.
Gotcha. So as of right now, it looks like we're out of questions. So I'll give people another minute if they have any to ask them. But in the meantime, Peter, could you share the best way to get in touch with you?
Yeah. Yeah. So the best way to get in touch with me, email me directly. My email is, I think you guys will provide it. It's
We
first
will.
initial last name. So it's P Powers at S as in Sam, P as in Paul, Venture Partners.com. So you can reach out directly to me via my email.
Perfect. And if you have any questions about this webinar or some of the stuff covered in it, and you need to be reminded of where to go, you can always reach out to CamaPlan at engage@camaplan.com or give us a call at 215-283-2868. But real quick, we do have one more question from Herv. On average, how many family offices invest in one of your deals? Do you raise a lot of money from one family office or a lot from several?
I'd say it's between each invest. So our check size on our loans is $2 to $7 million. So we'll typically have one big family, and then we'll bring a couple other investors in. And then on our equity deals, we'll have up to three families because we'll go up to like $10 million checks. So those families will, usually it's between $2 to $3 million a clip. So we'll bring a couple of those families in, and then we'll bring the rest of them in. Will be smaller checks, anywhere from 100,000 to 500,000.
There we go. Well, unless someone gets a question at the last second, Peter, thanks so much for joining us. I'm sure we'll be in contact soon. And of course, for anyone watching, you can find this replay on our YouTube or our website. And if you have any questions about it, feel free to reach out to us or reach out to Peter. Thanks so much for your time, Peter.
Thank you for your time, Michael. Take care.
All right, have a good one, everyone.